Okay, cool. Oh, you are a host too. Okay, great. Have a great weekend.
All right, have a great one, Johnny. We'll see you.
See ya.
All right, let's get rolling here. Interesting day in the market. I mean, if you got Don's session this morning, it's just like it's one of those things that's like you're around the market long enough. It's like, do you feel easy? Right? Do you feel easy? And basically saying, look, I mean, is the market effectively pricing stuff in, right? Is it effectively trading? And one of the things I've kind of encountered here is that I feel like there's a lot of really good option prints today. But man, the liquidity in the market over the last week or two has really diminished. So you go to trade and it's like, man, the spreads are wide, right? And so it's like the volatility is kind of creating a degree of havoc with some trading. But look, there's some stuff perking up today. There's some stuff shutting down. We'll take a look at it. But before we do, we're going to talk about risk ratios. We're going to look at how the market is transitioning or posturing itself, rotations, that sort of thing. Gianni mentioned high beta, right? So we're going to look at a ratio of high beta to low beta, high volatility to low volatility, the top 100 beta names to the lowest 100 beta names. We're going to compare them. We're going to pit them against each other, and we're going to see where do the rotations fall. So that's our we'll kind of take for today, or the direction we'll kind of take things. So let me just load my desktop here, and let's get on. So I always we'll kind of talk 90 RBAM. This is one of my risk ratios. It's the 3-month to 1-month VIX ratio. If you haven't caught some of my discussion over the last little over 2 weeks on volatility, I encourage you to check it out because it really kind of helps you understand and frame what's happening in the market right now. Not just the opportunities, but also the risks. Because right now the risks are extremely high. Question is whether those risks are realized. We really don't know, right? There's a degree of uncertainty in terms of there's no certainty saying the market's going to go down, the market's going to go up. So from a portfolio management perspective, and here Johnny mentioned, hey, we're kind of modified some things. The only way to manage portfolio level risk, and yesterday we kind of talked about the distinction between systemic risk and unsystematic risk. The only way to mitigate systematic risk is through portfolio level management. Now, could you blend your trades bullish and bearish? Yeah, maybe. Then when the systematic risk kicks in, which means a large down move in the market, all right, now that may help things. So you might be able to balance out your positions a little bit, but you better pick the right bearish positions, which sometimes isn't always certain. But the systematic risk of the market does tend to pull everything down for a period of time, at least. The unsystematic side is everything you're evaluating regarding trades. Hedges can help with systematic risk, right? So the idea is that this is a point in time where we're going to look at the risk ratios. Is this a point in time when systematic risk, the risk of a downside move dragging things down, is it high or not? Are we positioning ourselves? And when I say we're talking about institutions. Are they positioning themselves so that they can reduce systematic risk or capitalize on the downside risk of the market? All right, so let's get rolling here. So who's in the house today? Feel free to give a shout out. If you're new to TheoTRADE, feel free to let us know. If you have questions, comments, even some smart remarks, feel free to share those in the chat panel here today. So, all right, let's get rolling. So risk ratios. The point is we think about 90 RBAM risk ratios. What I'm talking about is how do you gauge your sentiment, right? Because this is a critical understanding, right? How do you determine market sentiment? And it's not enough to say it's a bull market or a bearish market. P-Butts is in the house. Peter's here as well, right? It's not enough to say, oh, we're in a bull market, we're in a bear market. That doesn't help you in trading, right? It doesn't. Can you say bullish trend? But we're not in a bullish trend. Kind of talked about that. We got Rogbro in the house as well. So we say we're not in a bullish trend. Well, why am I saying that? Because if we look at the S&P 500, SPX, we put in a lower low here. Now, what do we see today? We're putting in a higher high. So what we're exhibiting right now is a broadening formation. So it's great we put in a higher high, right? We also have a lower low. We're seeing broadening. Now, broadening are reversal formations, but they're not very powerful. Now, if you've been decidedly bearish, is this a wake-up call? If you're leaning 100% bearish, Is today a wake-up call for you? It probably should be. This breakout to new high may mean we're on pace. Are we going to pull back and test 65.50? No, we might form a higher low, and now we have a bullish trend again. We drew our trend lines. We talked about the fanning principle, right? The idea is that when a trend line breaks, you can't redraw it until we form a new high. We just formed a new high in the S&P 500 today. So now what do? I can redraw my trend line like this, right? So now this is the trend line of the market. Well, it's upward sloping. Are we in a bullish trend? You might conclude that yes, we are, right? But technically speaking, we don't have higher highs and higher lows, but we very well could have higher highs and lows. Now, technically, we did form a close below that low right there, so that could have been a higher low for you if it's one day. I just like to see some degree of correction coupled with time, but technically speaking, that was a resistance, and then today we're closing above that high. So again, is it reasonable to conclude we're in a bullish trend in the market? Sure. Is it reasonable to say we're kind of neutral, we're broadening, it's a potential reversal formation, but it's one of the weakest ones out there? Sure, it's fine to say that as well. Are we talking about seasonality wise, a good time going to the end of the year? Yeah, typically you get to November, December. We're not out of October yet, but very well. So my point is, if you've been decidedly bearish, today might be a wake-up call. You might need to get bullish, right? May need to add bullish. You can't stand on the losers that may be ready to expire worthless out here. The question being is, where do you go bullish? Where do you look for those opportunities that are out there at the moment? We're going to look at that, right? We're going to also look at some bearish opportunities as well in commodities, specifically USO. So Don says the implied volatility is all wrong for this market. I 100% agree. There is not a peaceful, easy feeling, right? And so what I'm saying, today's breakout, you might need to add, if you're 100% bearish, you might have to add some bullish positions. In ghost prints, we have what? We have an ARC trade that's kind of out of the money, which may come back. We got a week left. But I need this thing to get back around here towards 82. Might happen next week, may not. Maybe Tesla. We'll look at Tesla here. Option activity in Tesla is bad today, right? It's negative, highly negative. Two big time prints in Tesla on the downside. We have HYG, which is a bond trade, which we have lower inflation numbers. They shouldn't necessarily be that positive for HYG. But we've got a bit of time on that one. And it was initially moved for us for a couple days. Now it's kind of working against us today. We're down about 33%, which isn't a big deal. But we have mostly bullish trades, right? We have Rocket trying to make a move today, fading back. We have RR making a move today. ARRY trying to make a move today, falling back. Okay. We have Novavax not really trying to make a move, but all of these, we have it through earnings. So from my perspective, I have a lot of bullish stuff on, right? And I have some bearish trades. So I'm going to be looking to balance that out today. I'm looking to balance out right now my bullish and bearish trades. So we've got some squeeze bar type trades on right now with huge upside potential and an earnings event coming up. I'd love to be able to get out of them before the earnings. We'll see. But they've been languishing a little bit. They're perking up today. And so Billy says, are the new all-time highs really breaking out, or are they just barely moving up? Well, the all-time highs right now, again, just realize, okay? Realize that what we're experiencing right now is highly anomalous, and it should not make you feel easy, right? This is not an easy market. The pain trade right now, I would say, is to the upside. And when you see the prints today, you'll see that, yeah, there's definitely a downside bias to the market. As we look at the volatility, we look at the VIX. The VIX is coming off a little bit. We're at 16.76, but we need to compare back month versus front month vol. Don's kind of putting there. Back month vol is insane for all-time highs. Well, I would say, look, what we're seeing right now is that this ratio is moving higher, right? This ratio is moving higher, which means what? Volatility expectations are rising. Now for this, we want to see it above 1.2 to really put in a significant indication of a major 5 to 10% correction, right? So I would say we probably got a little bit more room to the upside. If we go to product depth here and we just focus on the futures pricing of it, so we'll go to curves, I'll just take off these other ones. So we'll see what's going on here. If I take the next two contracts, Nov and December, all right, we got 18.75 and we've got 19.3. If I just take a straight average, we're a little bit over 19. Now, if I compare this to the 3-month VIX, how close is it? The 3-month VIX is 19.29. So you can kind of see why I use the 3-month volatility as kind of a representation of what's happening in the front two contracts on the VIX futures, because we're comparing the 30-day weighted futures. And I realized I didn't do a 30-day weighted calculation. You're basically taking the 30-day weighted futures against the spot VIX. Okay. And so this ratio, 3-month plus VIX, we're seeing is we're creeping up back again. We're at about 15%, right? The 3-month VIX is about 15% higher than the spot VIX. This area here is starting to get kind of dicey. This area is extreme. If we can see that the 3-month volatility is 20% higher than the VIX, what we're really suggesting is the VIX futures market is in a steep contango. Now, what Don's talking about here is we jump out to Jan and we really see a big step up here. Last week, I talked about the notion of pure expectations theory. We're going to look at oil here in a minute, USO. But the idea is that pure expectations theory is, and this only applies to cash settled products, right? Oil is not cash settled, but volatility is. And what we're saying is the price is the price. We're saying as we get into the turn, December into January, vol expectations are really picking up. Okay. So we could say, look, at this end of the curve down here, and we include the VIX, we're approaching a steep contango market. But as we get into the turn into January, we're seeing vol expectations really picking up at 20%, right? It's no longer as flat of a curve as we were looked at a little over a week ago, but we're saying right now, 18.75 out to Jan at about 20.5. It's almost what? It's about 2 points difference. We were waiting within 1 point. Now, if we look at past times and go to the curves here, we can see past times and how steep the curve was in the past. Let's look at 10.18 and 7.16. So 7.16 was much more of a contango market. You'll notice the AUG contract and then the SEP contract. There's a much bigger difference there than we're seeing here. But you can see that we're starting to approach, compared to where we were a week ago, we're starting to approach that. And how do we know that? What's an easy way to see that is just by looking at this, and we're seeing this starting to rise again. We're starting to see the VIX curve steepen. We're starting to see volatility expectations pick up as we're breaking to a new high. And at the same time as we're seeing this, what is SKU doing? SKU yesterday ticked back up to 154. Well, we saw since the Friday sell-off right here, for example, right? Since we saw the Friday sell-off back here, we're beginning to see volatility normalize a little bit. We had another pretty volatile last week. Looks like we're not going to have that same scenario today unless we sell off going into the close. But the point is that the last 2 Fridays, the pickup in volatility in the spot market has allowed things to kind of normalize a little bit. And we're starting to see SKU really starting to reflect, and we're starting to see increased hedging activity. Now, what does this hedge represent? What causes SKU to rise? They're basically selling puts and buying calls. Wrong way. They're selling calls and buying puts. Well, if they're buying puts, why is volatility going down? It's because they're selling more calls, right? They're selling more calls than they're buying puts, but it's causing the implied volatility curve to go from a smile to a smirk to this, right? This is what SKU represents. It's the steepness of the slope of the implied volatility curve. You might be saying, well, where do I see this volatility curve? Go to product depth, type in SPX or SPY, click on options. Okay. We'll focus on out of the money. And we'll just focus on not all series. We'll look at the 31st. We'll look at today. We'll look at November 7th, November 14th, and the 21st. We'll focus on the monthly expirations. You'll notice for today's expiration, we do have a volatility smile. Looks more like a grin because anything can happen today, right? Anything. We could go up, we could go down. It's pricing and volatility away from the at the money strike. There's no skew today, right? For today's expiration. But when you get off of today's expiration, you realize there is skew. And we can notice that the SPX right now, if I go back to charts, SPX, where's the S&P right now? We're at 67.96. Go to product depth. Where's the lowest volatility at the moment? We're out here around 69.75 to 7,000. So S&P's at 67.97. As we look here, we're skewed out to around 7,000. 67.96 is back here at 6,800. So what we're seeing is volatility ramping up sharply on the put side. These are puts, right? Anything out of the money, which is, back here at 68. This side is calls. Call volatility is declining as we go out of the money from 6,800 to 7,000. They're selling these calls and they're buying these puts. This is what creates skew. The steepness of this slope represents the skew index. Does that make sense? So the point is that the market is increasingly pricing in the downside risk, but part and parcel of doing that means that we're going to see more frequent, smaller updates. Okay. So today the S&P is up 0.88%. But what is the ATR? So let's come in here. We'll go to edit studies. We'll load the ATR. Is today's move outside of the ATR range? The ATR for the SPX is 70 points. Okay. We look at yesterday's close, right? To today's high, 67.38 to what? 68.07. We're basically saying what? That's about 70 points. So yes, we're up 0.88% today in the S and now 0.9%, but realize we're actually just one ATR. This is an average day. It's just that the bias is to the upside until we see the risk. Okay. So the pot is boiling, about to blow the lid off the market. So which direction is we're going to blow the lid off? So we talked a bit about this yesterday. If you're going to blow the lid off the market, which direction is it going to occur? Up or down? Which direction does the market actually blow its lid? Downside, right? The market only blows its lid off to the upside. It just boils to the upside, right? You get to a rolling boil, we're boiling over, where the lid's popping off. That occurs to the downside. And so the market's increasingly pricing in that possibility. And liquidity, unfortunately, is actually kind of drying up a little bit. In a lot of these higher volatility names, the volatility conditions are not actually all that great. Are we back? I got kicked out, so I think we're back now. Share desktop 3, we'll fire away. I don't know if you guys can hear pounding, but my house is like completely torn apart. Unfortunately, I relied on my brother. I was like, okay, if you do this for me, okay, if you do this for me, I will give you my beloved Land Rover LR3 that I've had for about 10 years. And I've put work into it. I've and he's helped me with it, but he doesn't have a car and he's wanting to be a handyman. But I'm like, he's working, but this last week he wasn't working because they were slowing down. He went to California, got his daughter, and my house is complete disarray. And then we had the flooring put in, not by him, by other professionals, and they messed it up once. They messed it up twice. Now they're fixing it again, and I'm hoping this is the last time. But they showed up late, and so hopefully you don't see. So hopefully you don't hear pounding upstairs, right? So because they're pounding, they're taking up the floor and having to relay it. But anyway, it is not good because we had a bit of a leak in downstairs. I got a big hole in the ceiling that does have sheetrock in it, but it's not finished. But all the stuff in that room, the piano, the couch, all this stuff, it's in the family room downstairs. So that's all bogged up. There's nothing in the piano room, and my office is next to that. And then upstairs, my brother's doing the trim. He's doing a good job, but it's taking him forever. And so he's bringing his daughter and her mom, and like they're here, and like we're just in shambles. So anyway, how do professionals mess it up twice? Exactly. And so they actually made it worse. They got to the threshold from the laundry room into the dining room. And so I'm like, well, they kind of messed up the coloration. So I'm having to pull it out. Oh, geez. I just hit Jesus with my water bottle because Jesus was supposed to be on the piano, and it's on my desk here, which I love, but I hit Jesus with the water bottle. That's not good. Luckily, I did not break it. It's like it's a statue, it's like a porcelain, whatever. But I love it, but unfortunately, it should be on the piano, not on my desk where I frequently use wild hands. Anyway, all right, that's good. I'll get out of my my fix-it problems here. But I'll tell you the stuff that I decided to take back. Yes, probably 7 years of bad luck. The jobs that I decided to do, the sliding glass door. I was like, hey, I want to try that. Putting in the appliances, redoing the bathroom. That's the only stuff that's turned out right so far. Sheriff says I'll begin. Right, okay, you give me my penance. There we go. Thanks, Sheriff. I appreciate it. So the point is, look, just realize that while the duck may look calm on the water, its feet are moving 1,000,000 miles an hour just beneath the surface. So we just have to understand that, right? And you can only mitigate that risk by portfolio management. You can take some swings, but as we look at performance, if I look at 12 weeks, I can say gold's up 25%. Healthcare is now up 12%. Technology's here. XLU has fallen off a little bit. So as we look at the utilities to S&P ratio, SPY plus XLU, SPY plus XLU, are we to a point? Not working. Come on. Let's bring up trading view. Great. All right. Let me bring up trading view. Great thing about, here we go. Loaded. All right. We may have to go back to trading view. But as we look at the SPY to XLU risk, so this is the combination of the two. So if I come here to studies, load study set, and we bring up a pairs ratio, this is a ratio of the two. And last week we talked about this, right? Weekly, go back 4 weeks from today. So 1, 2, 3, 4. It's still not time to exit XLU. Okay. It's still not time to exit XLU. So you're still holding it, right? So this is the second week in a row that the SPYs outperformed XLU, but the significant outperformance in the last 4 weeks plus, look back at the last 6 weeks here, second best performing is right here, or third best performing now is XLU. So the idea is we're still not in the mode where you want to sell XLU and buy SPY. This is a binary trade. It's either own SPY or own XLU. And right now you're still owning XLU, but 1, 2, 3, 4 next week, could we get up here and surpass that level? Maybe, right? So if we see a big move in the market next week, we may see this ratio flip. Okay. So since back here, July 22nd, 21st, was it? We've been kind of this, or no, August 22nd, no, September 22nd. since September 22nd, the signal has been to own XLU over the S&P 500, and so far you've done well at it. Okay. The next ratio is SPY versus gold. Gold's had a big week this week. Is this the beginning of the next down leg for gold? Bearish trade today in silver. A little bit of bullish trade in gold, not a whole lot. Okay. It's taking forever to load after my incident. Let me just bring up trading view. Product super charts. So we'll go right here. So SPY plus GLD. Okay. Oh no, divided by. Sorry. I can actually use mathematical operators here. I cannot think or swim though. It's not divided by. If we're looking at this ratio, you'd want to look at it as a line chart. The question being is, if we were to go to a weekly chart, have we now broken out? The answer is no. Go back 1, 2, 3, 4, and we could actually bring up a rate of change on this, since this we can actually use. Oops. I forgot to click it twice. All right. So I'm going to change this to 4 and say, okay, so we're on a weekly chart here. So I can say, okay, has this blue line crossed the 0 line? The answer is no. Right? If I look at SPY plus XL divided by XLU, I can do a direct ratio in this. Has the blue line crossed the 0 line? The answer is no, it hasn't. Let's take a look at the next risk ratio. Okay. The S&P on a 4-week rate of change has not gained any real value despite being at record highs. We're still in a defensive rotation on a 4-week rate of change. What about cyclicals versus staples? Have we seen any change there? So we'll go XLP divided by XLY. Yes, we did see that 2 weeks ago where, oh, sorry, I went the wrong way. XLY divided by XLP. This doesn't seem right. But notice here, we're not back above 0. 2 weeks ago, we saw the narrative flip. Staples outperforming cyclicals. They're still outperforming on a 4-week rate of change basis. The blue line is not above 0. Okay, so that's where we stand right now. So going back to these risk ratios, we still have a defensive rotation. Is that coming off in the last 2 weeks? Yes. A little bit last week, a little bit more this week, but we're still underwater on a 4-week rate of change basis. So I'm not concerned about looking back 20 weeks or a year or 6 months or 5 months, 6 months, 3 months. 3 months should carry a little bit of weight. 6 months, not at all. 4 months, 4 weeks, for example, yes, right? That's probably going to be your biggest weighting. And so thus, every one of these risk ratios is based on basically a 4-week rate of change. We're basically looking at 4 to 6 weeks. Now, if we look at high beta versus low beta, right? SPHB plus SPLV. We're trying to gauge from this. These are the top 100 highest beta stocks divided by the lowest 100 beta stocks in the S&P 500. SPHB divided by SPLV. We are still in a high beta squeeze. We kind of touched the 0 line last week. This week, we're still flipping up here, right? So if we look at high beta, low volatility, we're still getting that squeeze in the market. Okay. We're still seeing that squeeze play continue. There's just not as much breadth to it. So Matt's coming on here. I forgot he was coming on at 11. So we're going to kind of turn our attention a little bit to the squeeze bar. Okay. Again, I showed this yesterday, but this is a new feature on the on Ghost Print's surveillance console. A couple of new features are we can export to CSV or Excel. We have a block trade setting here that automatically gets you to block trade. The squeeze bar tells you the squeeze potential of stocks based on interests that are related to short interest, right? Today, you'll see there's quite a few names in here. We're seeing option activity and that have squeeze bar potential. 3 and 4, Rocket Lab up. These are the ones that would be we'd most want to look at. How are we doing, Matt?
Hey, Brandon. How's it going? I was actually going to ask you about that, man. How funny.
Yeah. So I've been trying to get this done for a while. We created a lot of 100 list, which has got kind of a watch list I just created by hand. But I want to be able to have it automated because short interest changes. And I wanted to have a formula to be able to gauge the potential squeeze in a stock. So we have the gamma squeeze here. We have the short squeeze there.
Right on. I love it. I love it. And I wanted to just kind of pop on, and I know I sent you a message about this, but I think it'd be pretty cool to share with everybody that uh, somebody reached out to me and actually took a trade based off of using the console.
Uh-huh.
And everybody's probably familiar with this name after the last few days, but Beyond Meat.
Yeah.
So you knew where I was going with that. So we just want to show you guys here a really powerful idea that came across the console. Obviously, not everybody's going to catch every
Mm-hmm.
multi-bagger opportunity, but the point is they're in there. And if you spend a little bit of time, every day kind of looking for them, there's no reason you shouldn't come across a few multi-baggers here and there. So, Brandon, I don't know if you can show that screenshot. I was going to try to post it in the chat, but it wouldn't
Well,
let me
actually, I actually
export the
showed
file
it
type.
yesterday, I think, in here. But yeah, I'll bring it up again. Let me.
Okay, yeah.
But again, this is just it's just kind of representative of. Look, I mean, you may not always pick the right one, right? That definitely happens. It happens to me too, right? Where you just think, hey, um, trying to download it, Sean Finder, there we go.
It's a
But
PNG.
this is what he sent to Matt. But look, I mean, we've had not 800%, we've had 300% moves, 836%, $9,000. I mean, and the thing about this is that when this stuff's going on, it's so I'm going back to the 17th here, and we're looking at BYND. And I gotta reset my filters here, but the idea is that it's not hard to find this stuff, right? Is that when you start to see triggers like this, 14,000 contracts traded, mostly bought at the $3 strike price, we kind of get the middle squeeze only because it's less than 20%. There's some factors that go into that, but there is a degree of squeeze potential here. But again, you'll notice that it's the volume creates the gamma opportunity. And so again, you saw them the 17th, and there hasn't been anything since, right? We can go to subsequent days, well, except for when it started to explode. And then you see it
Mhm.
explode here, right? I mean, so the idea is that there's this calm that exists, that these trades that happen, and they're not just readily observable just normally, but this is a tool that's designed to pick up on when this stuff's going on, and gives you at least the opportunity, gives you the heads up on a small set of companies that this could happen.
Yeah, and the squeeze bar indicator on that one wasn't, I mean, it wasn't all the way,
Yeah,
bursting
and
at the but
there's some factors that go into that. So for example, if I bring it up BYND, if you want to look at and we're actually working on adding features that we're not even gonna have to go outside of the Ghost Prince console, but um so I got statistics here. Some of the factors are, we have, that's interesting. It should be pegged. I'll have to investigate on that one. That should be pegged. Let me look at
yeah.
Finviz. No, I'll worry about it. But that should be pegged at 54% as of September 30th. I'll have to see when they're getting their data, their updates. So, but we just added this yesterday, so yeah. I'll have to check into that. Yeah, that's interesting. I didn't know. Yeah, I forgot it was 54% short.
Right. Yeah, and then just looking at the chart here on my phone, that
So
was
that one should be right here at the four bars should be filled up. So we just launched it again. I got to feel out. Okay, where are their gaps? And maybe they did the calculation wrong, whatever. But we'll be able to get this fixed pretty quickly though.
yeah, nice. So yeah, that's incredible. I was just looking at the chart of Beyond, and the 17th was actually like the last day before it started to just really,
Yeah.
you know,
Yeah, and
s-
that's why we do it. The idea is that you have 54% short interest here. right? At least as of the 30th. And you're saying, well, there's definitely not any covering at this point, right? Price is still going down, right? The stock's probably being shorted more, maybe. But the point being is that when you see this, the idea is that these kinds of companies have huge short squeeze potential. And so that at that point in time, you're seeing call buying come in. And the question always, well, is it hedges? Probably, but it doesn't matter, right? Because the idea is they're buying the $3 strike price. This gives you a level. If we can get to and through, we'll just explode. So we saw an explosion 2, 3. Once we broke 3, we just came uncorked and almost approached 8 before backing off. And so there's two things we learned from this, that oftentimes the hedges create the initial movement before the squeeze, and it gives you a heads up ahead of time. Number two is that these stocks have limited shelf lives. There's a way to trade them and there's a way to not trade them. And buying stock is more than likely the way to not trade them. The options market's giving you huge advantages. So learning how to buy call options, learning how to trade call spreads is the way to do it. And we have a whole education on that in Ghost Prints.
Nice. Yeah, and if you think about it, it's a little bit ironic that technically the hedge could actually be very counterproductive if someone has a large short on that stock, because that could be the very catalyst that, I mean, the hedge, obviously they'll get paid on the hedge, but then they, what was an otherwise profitable trade, I mean, there's no way of knowing for sure, but that could have been one of the catalysts that caused their short to go awry. So
and it's one of those things that, I mean, because if they're buying calls to hedge a short and they sell puts and buy calls, it's just the opposite, right? In these kind of companies that the market maker has to sell the calls. Well, if they're selling 10,000 contracts, there's not going to be someone there ready to pick up 10,000. The market maker has to then sell the calls. They're on the hook. They buy stock, right? So, for example, today, this isn't a huge trade, but this is not it's not the most like heavily traded options. So again, there's kind of varying degrees of this, but LAZR today. So LAZR, we just focus on stuff that's being bought, and you'll see here to the 250 calls. Well, we're upwards of 28,000 contracts right now on the October 31st 250s. Well, if we look at the effect of that, just LAZR, right? So, I mean, what's changed for LAZR? Sorry, LAZR. I didn't look right. LAZR is up what? Up about 23% today. Well, what creates this, right? Well, you're seeing that this might be the first leg of a major squeeze. And you can go back and see, wow, how big moves these kinds of stocks can make. They can literally double in a matter of a week. And so today we're at 40 cents. It's, up 23%, but we could see another 23. Well, again, how do we gauge this? So what the squeeze bar's looking at is it's getting behind the scenes here, and it's saying LAZR. And you'll see down here, we have what? We have a 20% short interest, 2.8 on the short ratio. So anything over 20%, you're going to get the 4 bars filled up. There's some other factors that go into it, but you're going to get those 4 bars filled up, and we're saying, hey, there's big time squeeze potential. So as we look at LAZR today, this might just be the beginning of the move, but where's the open interest being built? So we go here, it was a front week, not front week. Where is it? 28,000 contracts right there. We're now creating a gamma level at 250. So if we just see a flood of buying activity, the market maker has to absorb a lot of it. This creates a gamma squeeze and a gamma level. Now it's out of the money. So if we don't get to 250, this delta is just going to fade away, right? But if we can get to and through 250, this is where the magic can really happen. So the price level it has to attain, what I call the gamma level. And if we can get to and through 250, we could easily see a squeeze to 4.
Yeah. Yeah. Very cool. Very cool. So excuse me here. I'm just loading the boat on some LAZR shares. Just kidding.
Well, I mean, again, shares are tough because these stocks can go down 30% in a day. So when we look at the option side of it, let me first just share this with you, is that if I go to studies and I go to, I'm going to load my study set here for auto expect and move. This is Don's auto expect and move with an addition that gives me an EM multiplier. So I can go 3 times. And so what this allows me to do is say, well, how often does LAZR make 3 standard deviation moves? 99.7% of the time, it should stay between the bands. Well, we did right here. There's one, right? Go back. There's two. We touched 3 times the expected move. Almost there. There's 3 times outside the expected move, right? We go back further. We say, okay, here's 4 times. Here's 5 times we went below the 3 times the expected move. So when you look at this, you realize 5 times, well, 99.7% of the time, it should stay in the bands. And so the idea is, and yet we have 5 times, 4 of which to root to the upside, 1 of which to the downside. This is skew, positive skew, bullish skew that's created because of the short interest. But just realize we're hitting 3 times the expected move way more frequently than we should. So the way that you can approach these is, rather than buying stocks, saying, look, I'll buy the 250 call. Well, why would I buy a call with 200% volatility, 300% volatility? Because it's cheap. Well, why is it cheap? Because look at what's happened in the past. This stock makes extraordinary moves all the time, right? Relative to what it statistically or should based on probabilities. The second thing is I could trade spreads. So 256, this one actually dropping out here to get out to 354, maybe go short amounts of time. The bid-ask spread might be influencing that as well. But generally speaking, you see vol fall here and it rises here. You can't construct call spreads. But on this little price of a stock, just buy a call. This is way out. I mean, $4 way out of the money here. But so these are the kind of stocks. Buy a call instead of stock. Look for the big move. You get a big move. We get through 250. We get to 3. Roll it. Move it to a higher strike price. Take money out. That's how you manage these trades.
Nice. And guys, the way Brandon just described that is why he's a pro trader. So you see how he's using everything. Everything is basically an equation. He's fitting everything into a model. So it's not just, rolling the dice, right? So now if you guys want to learn more about, the new squeeze bar indicator and finding more of these trades, just like LAZR is on there today, we're actually doing a webinar on Monday. So I have a fresh link hot off the press for you guys. So what I'm going to do is I'm going to post this in the chat right now. You guys can go ahead, smash this link, give it a hearty click, and go ahead and register for that webinar on Monday and sign up for that webinar. And then that way you guys will make sure that you get a link when that webinar is going live, because we'd hate for you to miss it, because Brandon's going to go live and do a little bit more in depth on the squeeze bar, of course, overall the console, the other aspects of it too. But if you guys want to see exactly what this new development is with the console and how powerful it is, adding to what Brandon just described and how he laid it out, go ahead and smash that link. And yes, smash it with a hearty link. That's right, Ed. And
Don't break the mouse, but
yeah, give
use
it
a heavy finger.
And get registered, and we'll see you guys. We'll see you guys on the webinar with Monday with Mr. Chapman. But all right, Brandon. Well, hey, I'm gonna hop off. I just wanted to come on and kind of share that trade with you, and maybe just kind of mix it up a little bit. And everyone, I'll be on at 4 o'clock at the closing bell, and we'll see everyone later. Thanks, Brandon. Thanks for having me hop on.
Hey, thanks, Matt. Have a good one.
Yeah, see you later.
So I promised I'd bring up Tesla, right? So again, we've kind of looked through the risk ratios. We understand the climate we're in. It's teetering on the bearish side. Can we get out of it? Sure we can. But we're talking about Tesla here. Tesla, for example, 255, 250s, November 14, October 31st. I mean, they stepped in about 20,000 contracts. That's one trade, folks. Who's buying 20,000 puts on Tesla? Could it be a hedge? Sure it can. Doesn't matter. It doesn't. They bought 18,500 250 puts for no 14. Okay. Are these way out of the money? Yes, they are, right? They're not going to be great hedges, but it's just representative of takes that just these way out of the money trades that are being taken on stocks like Tesla. These way out of the money swings. Again, just thinking, hey, can we see a major move, right? 20,000 contracts right there, 255. And again, we're talking a zero delta. These are lottery tickets, could be part of another type of trade that they're doing. But the point is that these are big trades going on in Tesla today. Again, does it mean you go bearish Tesla? Maybe, right? I mean, is this a bad stock to trade to the downside? No. right? In fact, if you don't have, so if we look here at Tesla here, 28 days out, notice that we have what? We got 250 wide spreads. That's not bad for a $400 stock. And there is plenty of depth in here. Like you can get out here to like a 40 delta, buy vertical. It's going to cost you $1.10, right? Is it really cheap? No, it's not. You're buying and selling about the exact same volatility, right? If you have a smaller account, you want to take a swing. What about TSLL? Now, frequently TSLL has a fair amount of depth and liquidity, right? We got hundreds and thousands of contracts here. If you want to take a swing using a $19 product, there's no additional leverage because this is 2 times, but you could take a swing in here, for example, 50-cent increments on the spreads, right? 40 delta. Could you buy this and sell $4, 4 strikes wide vertical? Yeah, 84 cents, right? Get you under 100. You could do a $1.50 spread. You could buy a put. You could buy it in the money put. Give yourself a little bit more time. So the thing is, this is where I tend to use like leverage products, especially in higher price stocks where you want tighter distances between the strike prices, cheaper because they're generally lower prices, cheaper calls and puts so you can position size around, right? But anyway, they haven't updated the webinar, but it is Monday though. It is Monday. So, but I do it every Monday at, so I do it on Monday at 2:00 Eastern. So love to have you there if you want to show up. Again, we're going to dig into the squeeze bar specifically. And wait a second, I'm OT right now. Tony is ready to go. We got to admit him. How are we doing, Tony?
Yo, I'm here, man. Sorry about that.
No, it's okay. Matt was on, so we kind of went a little bit over, but
all right, cool.
I'll pass the ball. I hope this is helpful, just framing things, but also we saw a bullish opportunity. We saw a bearish opportunity. We saw the squeeze bar, parameter, indicator, whatever you want to call it. Gives you a chance to really kind of capitalize on this. Anyway, see you, Tony. Have a great weekend.
Have a great weekend, dude. You too. What's going on, everybody? So all-time highs all around.